Imagine working for 40 years, paying your taxes, tracking your balance every single month, and retiring with absolute peace of mind. Only to realize that the income you thought was guaranteed is quietly being eroded by a hidden mechanical trap that almost nobody talks about. We are told from our very first job that Social Security is the bedrock of American retirement. It is the steady check, the dependable baseline, the promise that after decades of labor, the system will catch you when you step away from work. And for millions of retirees, that check does arrive like clockwork. But here is where the story takes a sharp, unexpected turn. What most people fail to realize is that the dollar amount printed on your official Social Security statement is not your actual retirement income. Not even close. Between federal tax laws written decades ago, hidden thresholds that haven't kept pace with modern reality, and the strange way benefits interact with other retirement accounts, a significant portion of that money can quietly vanish before it ever pays a grocery bill or covers a prescription. And the most fascinating part is not just the math. It is why intelligent, financially responsible people continue to miss it until it is too late. Let us step back for a moment and look at how we arrived here. When the Social Security system was originally designed, the financial landscape of the country looked entirely different. Life expectancies were shorter, pension plans were common, and the tax code did not treat retirement benefits like ordinary wages. For decades, the system operated under a simple premise. You paid in while you worked, and you received your benefits tax-free when you stopped. People planned their entire lives around that simple promise. They calculated their future expenses based on gross benefit numbers, assuming that $1,000 from Social Security meant $1,000 in purchasing power. Then came a shift in the law. In the early 1980s, facing severe funding pressures, lawmakers introduced a mechanism that fundamentally changed how retirement income is viewed. They created what economists call a provisional income formula. Suddenly, benefits were no longer universally exempt from taxation. Instead, a complex sliding scale was introduced, one that tied the taxability of your Social Security directly to your other sources of retirement income. Here is where human psychology immediately steps in to create a trap. When people save diligently throughout their working lives, contributing to traditional IRAs, building up 401(k) accounts, or earning modest interest from personal savings, they view those actions as purely positive. They believe that saving more money can only ever benefit them in retirement. And logically, it should. If you work harder, save more, and generate a slightly higher income in retirement, you should be wealthier. But because of how the Social Security tax rules are structured, crossing certain income thresholds triggers a bizarre cascading effect. As your other retirement income increases by just $1, a portion of your previously tax-free Social Security benefit suddenly becomes taxable. This creates an invisible marginal tax rate that catches retirees completely off guard. Many find themselves paying an effective tax rate on that marginal dollar that is significantly higher than they ever anticipated, not because the official tax brackets changed, but because of the way different streams of income interact behind the scenes. Consider the story of a retired couple. Let us call them Arthur and Alina. They planned for retirement with textbook precision. They eliminated their mortgage, built a healthy traditional retirement account, and waited until their full retirement age to claim their benefits. They felt secure. They had done everything right. But within their first year of drawing retirement income, they noticed something unsettling. Their tax bill was noticeably higher than their financial projections had indicated. At first, they assumed it was a simple accounting error. They checked their deductions. They reviewed their local property taxes. Nothing seemed out of the ordinary. Then their tax professional pointed out the hidden mechanism at play. Because Arthur and Alina were withdrawing from their traditional retirement accounts to supplement their lifestyle, their combined income, calculated using that specific provisional formula, crossed a threshold that had been frozen in place for decades without adjusting for inflation. Even though the cost of living had risen dramatically over the years, the income thresholds that determine the taxation of Social Security benefits had not moved upward in tandem. The result: a portion of the very benefit they relied on for basic stability was now being pulled back into the tax system. It was not a scam. It was not a hidden fee charged by a bank. It was simply the mechanical outcome of a policy rule interacting with standard retirement withdrawals. And this leads us to a deeper question. Why do so many smart, capable people walk directly into this scenario without seeing it coming? The answer lies in how our brains process financial planning. Behavioral economists call it mental accounting. We tend to place our money into rigid, separate mental boxes. This box is for Social Security, this box is for my 401(k), this box is for personal savings. We analyze each box in isolation, assuming they operate independently. We rarely pause to examine how pulling a lever in one box alters the physics of the other boxes. When you withdraw money from a tax-deferred account, your brain registers the immediate utility of having cash in hand. It does not automatically calculate the secondary consequence, that the withdrawal is artificially inflating your adjusted income, which in turn strips away the tax shelter protecting your Social Security benefit. It feels like a hidden penalty, even though it is fully written into the tax code. And once you begin to see this pattern, you start to notice how many other retirement assumptions rest on similar fragile foundations. For instance, many people believe that waiting until age 70 to claim the maximum possible Social Security benefit is an absolute shield against financial shortfalls. And mathematically, the delayed retirement credits are substantial, boosting your monthly payout significantly compared to claiming early. But here is the twist that rarely makes it into standard retirement advice. By pushing your baseline guaranteed income higher through delayed claiming, you may inadvertently push your baseline taxable income higher for every subsequent year of your retirement. If you also have large traditional retirement accounts waiting to be tapped, especially once mandatory withdrawals begin later in life, the combination of a high Social Security benefit and required distributions can lock you into a higher tax bracket than you ever experienced during your peak earning years. It is a profound irony of modern financial planning. The very strategies designed to maximize your safety can, if implemented without a holistic view of the tax code, create a complex web of tax friction that drains your purchasing power precisely when you need it to be most resilient. And that brings us to an entirely separate layer of friction that catches people completely unaware: the silent erosion of purchasing power caused by the timeline of government adjustments. Most people assume that because cost of living adjustments, or COLAs, are applied to Social Security checks annually, their standard of living is safely protected against inflation. But mathematically and behaviorally, reality tells a different story. COLA increases are calculated using a consumer price index metric that tracks a broad basket of goods, which often fails to mirror the specific, localized inflation experienced by retirees, particularly the skyrocketing costs of healthcare, property maintenance, and insurance. When your actual expenses rise faster than your government adjustment, a subtle gap opens up between your gross check and your real-world buying power. Worse still, because those nominal COLA bumps push your gross income slightly higher year after year, they can gradually edge you across those unindexed tax thresholds we talked about earlier. Meaning the government gives you an inflation adjustment with one hand and claws a portion of it back through taxation with the other. It feels like running on a treadmill that slowly increases its speed while you are trying to catch your breath, which transitions us directly into another overlooked layer: the generational transfer trap and beneficiary blind spots. When retirees pass away, leaving behind a traditional IRA or a heavily structured retirement portfolio, they often assume their hard-earned wealth will seamlessly support their surviving spouse or children. They focus entirely on asset division, making sure names are listed correctly on paper. What they fail to calculate is the brutal tax reality of inheriting pre-tax accounts under modern federal rules, such as the rapid drawdown mandates that force beneficiaries to empty inherited IRAs within a compressed timeframe. When a surviving spouse or a working child is suddenly forced to absorb a massive lump sum distribution into their own active earning years, the tax impact can be staggering, vaporizing a huge chunk of the inheritance before it ever fulfills its intended purpose. The wealth you spent a lifetime accumulating becomes an accidental tax liability overnight. And finally, this exposes the ultimate psychological trap of retirement: the illusion of the final finish line. We spend decades treating retirement as a single, permanent destination, a place where the work stops, the checks start, and the math settles down forever.